So if you were navigating a massive cargo ship across the Pacific Ocean, would you rely on a plastic toy compass from a cereal box to guide you?
I mean, I certainly hope not.
Right. Of course not. It might, point you generally north if you're just paddling around a small pond.
Hmm.
But on the open ocean, it is basically a guaranteed recipe for a shipwreck.
Yeah, you wouldn't make it very far.
Exactly. Yet, that is essentially what happens when high net worth investors use standard risk management advice to protect multi-million-dollar portfolios.
It's a completely different environment.
It really is. So, welcome to the deep dive. Our mission today is to deconstruct exactly why that happens and, well, what you should be doing instead.
And we're pulling from some incredibly detailed material today. We're specifically focusing on the 7 critical reasons high net worth investors need a completely different approach to risk management.
Right, and this is coming from the research and insights of Davies Wealth Management. They're a fee-only fiduciary advisor based in Stuart, Florida.
Yeah, from their 1715 Treasure Coast financial wellness platform. And the core takeaway across all this material is that the rules that build wealth are fundamentally different from the rules required to protect and preserve it.
That makes a lot of sense. The very definition of risk seems to morph as a balance sheet grows.
It absolutely does.
Because, when someone has a standard $100,000 retirement account, risk just means the stock market goes down.
Right, it's just market volatility at that point.
But once wealth pushes past the $1 million mark, especially when it's scattered across taxable accounts, deferred compensation, real estate, and maybe a business risk evolves into this massive, interconnected web of threats.
It becomes incredibly complex.
So to understand this web, let's start with how people actually accumulate this level of wealth in the first place. Because you don't usually get to a $10 million net worth by just quietly saving 10% of your paycheck into a generic index fund.
Rarely. We see this constantly with executives, founders, and even professional athletes.
They usually have one big thing that hits, right?
Exactly. The wealth explosion usually comes from one highly successful venture. It might be a business they built from the ground up, or a massive real estate play.
Or a long career at a tech company where they got heavily compensated in stock.
Right, which introduces the first hidden massive threat, and that is concentration risk.
Okay, unpack that a bit.
So it's very common for these individuals to hold 30 to 70% of their entire net worth in a single company's stock, usually through restricted stock units or, incentive stock options.
Okay, let's stop right there. Because if the danger of holding all your wealth in one single stock is so incredibly obvious, why don't they just sell it and buy a diversified portfolio?
It seems like the logical move, doesn't it?
We all know an index fund might drop 20% in a terrible year, but a single stock can drop 80% or literally go to zero. So why hold on and risk everything?
Because selling triggers the second interconnected threat in this web, which is tax risk.
Ah, the IRS steps in.
Yeah, it creates this paralyzing gridlock for the investor. If you're in the top federal tax bracket, which is 37%, for married couples with taxable income over roughly $609,000 in 2024, liquidating that concentrated stock triggers a monumental capital gains tax bill.
So they hold on because they're terrified of the tax hit.
Exactly. But doing so leaves them dangerously exposed to the concentration risk. Plus, there is almost always a deep emotional attachment.
Oh, sure. They built that company.
Right. Or they spent 20 years working there. It totally clouds their judgment.
So they're trapped. One door leads to a steep cliff where their single stock plummets, and the other door leads directly to the IRS confiscating a third of their net worth.
It's a tough spot to be in.
How do you possibly pick the lock on a door like that without triggering a massive tax event?
Well, this is where high net worth risk management entirely diverges from standard advice. You don't just hit sell on your brokerage app.
So what do you do?
You employ specialized structural strategies. Take an exchange fund, for example.
Okay, what is that?
This is a mechanism where an investor pools their highly concentrated stock with a group of other investors who hold different concentrated stocks.
Hold on, wait. If I pool my stock with a bunch of other people, isn't that technically a transaction? How is the IRS not taxing that as a sale?
It's a fair question. Under specific tax code provisions, contributing your shares to a partnership, which is fundamentally what an exchange fund is not treated as a taxable sale.
Oh, interesting.
Yeah, you're exchanging your individual shares for units of the partnership. By doing this, you receive a diversified portfolio of all the pooled stocks in return.
And you defer the capital gains tax entirely.
Completely. Until you eventually sell your partnership units years down the line, you instantly dissolve the concentration risk without paying the toll to the IRS.
That is fascinating. You essentially crowdsource your own diversified index fund.
That's a great way to put it.
What other tools do they use to untangle this? Because I imagine exchange funds aren't the only option.
No, not at all. Another powerful mechanism is a charitable remainder trust, or a CRT.
Okay, how does that one work?
An investor transfers the highly appreciated stock into the trust. And because the trust is a tax-exempt entity, it can sell the stock without paying any immediate capital gains tax.
Wow, okay.
Then the trust pays the investor an income stream for life or for a set number of years, and whatever is left over eventually goes to a designated charity.
So the investor avoids the immediate tax hit, creates a customized pension for themselves out of the proceeds, and gets a charitable income tax deduction up front just for setting it up.
Exactly. And they diversify their risk because the trust can reinvest the proceeds of the stock sale into a broad portfolio.
What about corporate executives who can't even move their stock because they're restricted by insider trading windows?
For them, they utilize 10b5-1 trading plans.
Sounds very technical.
It is. It's a legal framework that systematically sells shares on a preset automated schedule.
So it takes the emotion out of it.
And the legal risk. Because it's arranged in advance when they don't have non-public information, it protects them from insider trading accusations while slowly, methodically bleeding off the concentration risk over time.
Okay, so we've protected the portfolio from the IRS while untangling the concentrated stock. But tax risk isn't just a one-time event when you sell a big asset, is it?
Not at all.
It seems like taxes act as a constant drag on the entire portfolio if you aren't paying attention.
Tax inefficiency is a silent, wealth-destroying force. I mean, over a decade, the difference between a tax-aware portfolio and a tax-unaware one can literally be hundreds of thousands of dollars.
That's massive.
High net worth investors don't just buy mutual funds. They employ aggressive defenses like direct indexing to harvest tax losses.
Okay, let's walk through the actual math on that because I want to make sure I understand why this is such a superpower compared to just owning an S&P 500 mutual fund.
Sure. Let's say the S&P 500 goes up 10% for the year. If you own a mutual fund, your out goes up. But the fund manager was likely buying and selling inside the fund, generating capital gains.
So you get a tax bill at the end of the year, even if you didn't sell any of your own shares.
Exactly. With direct indexing, you don't own the fund. You directly own all 500 individual stocks that make up the index.
So my software is managing 500 tiny positions.
Correct. Now, even though the index as a whole went up 10%, maybe 350 of those companies went up and 150 of them actually lost value.
Because not every stock goes up at the same time.
Right. So your advisor systematically sells the 150 losers to capture the tax loss and immediately replaces them with similar companies to maintain the structure of the index.
Oh, I see.
You then use those harvested losses to offset the gains from the winners or to offset the sale of that concentrated stock we talked about earlier.
Wow. Your overall portfolio grew by 10%, but you mathematically engineered a tax deduction out of the underlying volatility.
You got it.
You're using the inevitable losers to shield the winners.
Yeah.
That is brilliant. And the sources from Davies Wealth Management also point out that managing taxes isn't just about capital gain.
No, it's broader than that.
It's also about managing your income bracket in retirement to avoid hidden penalties. They specifically call out IRMAA.
Right. The income-related monthly adjustment amount. This is a massive blind spot for affluent retirees.
What does it actually do?
It dictates your Medicare premiums. And it is not a gradual, progressive tax. It operates as a steep cliff.
Really?
If a married couple's modified adjusted gross income in 2024 crosses $206,000, even by one single dollar, their Medicare premiums violently spike.
So a sophisticated risk plan has to meticulously control exactly where the cash is coming from each month. Like pulling $10,000 from a traditional IRA might push you over that cliff, whereas pulling it from a Roth IRA or a taxable brokerage account might keep you safely under it.
Which is why they strategically utilized Roth conversion ladders during lower income years.
Paying the taxes early.
Yeah, they pay taxes at a known lower rate today, converting traditional IRA funds to Roth IRA funds, so that later in retirement, they have tax-free buckets to pull from without triggering those massive IRMAA surcharges.
Okay, so this brings up an interesting pivot point. We've established this fortress to protect the money from taxes while it grows. But eventually, you have to flip the switch from accumulating wealth to actually draining it to live your life.
That's the whole point of saving, right?
Right. So does the strategy change when you start spending the money?
Dramatically. The moment you start withdrawing funds, you are exposed to sequence of returns risk.
That sounds ominous.
It is arguably the most consequential danger for an affluent retiree because it's entirely based on the arbitrary timing of the stock market.
Think about sequence of returns risk, like taking a cross-country road trip.
Okay, I like this.
If you hit a massive pothole and blow out a tire in the first 5 miles of your journey, it derails everything. You're stranded, you're paying for a tow, your schedule is ruined.
Right, it's a disaster.
But if you blow out a tire as you're pulling into your own driveway at the very end of the trip, it barely matters at all. You still successfully made it to your destination.
That's a perfect analogy. And to take your flat tire analogy a step further, imagine that to pay for the tow truck in those first 5 miles, you had to permanently sell pieces of your car's engine.
Man.
By the time you get back on the road, you don't have enough horsepower left to actually reach your destination.
So bring that back to the portfolio.
If someone retires early with a $5 million portfolio and the stock market drops 30% in year one, what happens? They still have to eat, travel, and pay property taxes.
So they're forced to sell stocks while they're down 30% to generate cash.
Exactly. They are locking in the losses.
They are permanently cannibalizing the engine that generates their wealth.
Those shares are gone forever. They cannot participate when the market inevitably recovers. But a 30% drop in year 15 of retirement has a drastically smaller impact.
Because the portfolio has had a decade and a half of compounding growth to absorb the blow.
Precisely.
But you can't control the stock market. I mean, nobody knows if it's going to crash the day after they retire. How do you defend against arbitrary timing?
You build a mechanical shock absorber. The defense mechanism is a meticulously calculated cash buffer.
How big of a buffer are we talking?
A fiduciary advisor will typically carve out 12 to 36 months worth of living expenses and hold it in pure cash or short-term, high-quality bonds.
So when the market tanks in year one,
The client doesn't sell a single stock. They live entirely off the cash reserve for 2 or 3 years, giving the equity side of the portfolio the time it needs to recover.
you're literally buying time. But while you're sitting in cash waiting out a market storm, there's another silent thief eating away at your purchasing power, and that's inflation.
Yes, inflation is always the invisible enemy.
And the materials point out a fascinating distinction here. The inflation that high net worth families experience is entirely different from the generic consumer price index that we hear about on the news.
Right. The standard CPI measures a basket of basic goods, milk, eggs, average housing, basic transportation.
Stuff everyone needs.
But affluent inflation is driven by completely different hyperinflating categories. We're talking about specialized out-of-pocket healthcare, luxury travel, premium real estate maintenance, and specialized professional services.
And those inflate faster.
Those sectors inflate at a significantly faster rate than the headline CPI.
Meaning if you need $250,000 a year to maintain your lifestyle today, you can't just aim to generate that same amount in 20 years.
Not even close.
At a 3.5% inflation rate, you will need over $500,000 a year just to buy the exact same life.
This is why the greatest risk a wealthy investor can take is getting too conservative too early.
Oh, because if you just park $5 million in standard safe municipal bonds yielding 3%.
Affluent inflation will quietly and violently erode your purchasing power. To survive a 30-year retirement, the portfolio must maintain a highly meaningful allocation to growth equities and real assets.
Like what?
Things like commercial real estate, infrastructure, or Treasury inflation-protected securities to continually outpace that specific higher inflation rate.
All right, so market math and inflation are one side of the coin. But that assumes all the threats are coming from the economy. What about the threats that walk right up to your front door?
You mean liability?
Yeah. Wealth acts as a giant magnet for external liabilities.
It absolutely does. The sheer presence of a high net worth attracts litigation.
So a business owner dealing with a disgruntled employee, a physician facing malpractice exposure, or even a real estate investor dealing with an injury on their property.
A standard homeowner's or auto insurance policy is entirely useless. It will not even scratch the surface of their exposure.
So what does the actual shield look like? Because they have to protect themselves.
It requires a multi-layered defense. The first layer is umbrella insurance, usually carrying policies of 5 million, 10 million, or more.
Okay, that makes sense.
It sits on top of existing policies and provides a massive wall of capital against a lawsuit. But insurance has limits and exclusions. The underlying assets themselves must be structurally quarantined.
Meaning you don't hold investment properties in your own name.
Never. You use limited liability companies, or LLCs, to contain the liability.
So if someone slips and falls in an apartment building you own?
They can sue the LLC that owns the building, but they generally cannot penetrate the LLC to go after your personal brokerage account or your primary residence. And for extreme bulletproof protection, high net worth individuals utilize asset protection trusts set up in states with uniquely favorable trust laws, like Nevada or South Dakota.
So you transfer assets into these trusts, and they are legally partitioned away from future creditors.
Exactly.
It's like building a moat, then a stone wall, and putting the gold in a vault.
That's the goal.
But even if you successfully keep the creditors out, there is still the government to deal with. And looking at the Davies wealth management material, there is a massive ticking time bomb regarding the federal estate tax.
The 2026 estate tax sunset. It is perhaps the most urgent planning crisis for high net worth families right now.
Why is it such a crisis?
Well, currently in 2024, the federal estate tax exemption is historically massive. It sits at $13.61 million per individual.
So a married couple can pass over $27 million to their heirs entirely tax-free.
Correct. But the law that created those massive exemptions is set to expire at the end of 2025.
In sunsets.
Yes. On January 1st, 2026, the exemption gets cut roughly in half, dropping back down to around $7 million per individual, adjusted for inflation.
Which means families who think they're completely safe right now are sleepwalking into a brutal trap.
A huge trap.
Because if your estate is over that new limit, every single dollar above the threshold gets hit with a 40% federal estate tax.
And this is where families deeply underestimate what the IRS considers part of their estate.
How so?
They look at their stock portfolio and think, well, I only have $4 million in the market. I'm well under the $7 million limit. But the IRS counts absolutely everything.
Like the house.
The equity in your primary home, the value of your business, your retirement accounts, and crucially, the death benefits of your life insurance policies.
Wait, really? A standard life insurance policy counts toward the limit?
Yes. A healthy business owner might have a $3 million term life policy just to protect their family.
When they pass away?
That $3 million is added to their net worth. It instantly pushes them over the new lower exemption threshold. And suddenly the family is handing over 40% of the overage to the government. They never saw it coming.
Okay, let's slow down. You just mentioned the window is closing rapidly.
Yep.
We only have until the end of 2025. The material outlines a whole alphabet soup of defense mechanisms to dodge this.
Oh, yeah. SLATs, ILITs, dynasty trusts.
Let's break down the mechanics. How does a SLAT actually work?
SUSLAT stands for Spousal Lifetime Access Trust. The mechanism is designed to lock in today's massive $13 million exemption before it disappears.
Okay.
One spouse takes, say, $10 million of assets and irrevocably gifts it into the trust for the benefit of the other spouse.
Well, wait. If it's irrevocable, meaning you permanently give it away, how does the family still use the money? Doesn't the IRS see right through a husband just handing money to his wife?
That is the brilliant loophole of a SLAT. You are permanently parting with the asset, which removes it from your taxable estate. However, the trustee who manages the trust is allowed to make distributions to the beneficiary spouse to maintain their standard of living.
So because the spouses share a household and a life, the family indirectly continues to benefit from the assets.
Exactly. But when they eventually pass away, that $10 million plus all the growth it generated over the decades is entirely immune from the 40% estate tax.
It's basically an invisible vault. You could reach in and take what you need, but the IRS isn't allowed to see it.
That's a great visual.
What about the life insurance trap you mentioned? How do you fix that?
You use an ILOT, an irrevocable life insurance trust.
Okay, another trust.
Yep. Instead of you owning the life insurance policy, you have the trust own it. You gift the cash to the trust to pay the premiums.
And then what?
When you pass away, the death benefit pays out directly to the trust, completely bypassing your personal estate, neutralizing the estate tax threat entirely.
You know, you can architect the most flawless trust structures. You can perfectly optimize your direct indexing for tax loss harvesting. You can build the ultimate cash buffer to defend against sequence of returns.
Right.
And yet, the entire system can still completely collapse in an afternoon
It really can.
because of the human brain.
Behavioral risk. It is the final and often most destructive vulnerability.
I want to push back on this, though, because it's easy to say people panic. But aren't these highly successful, intelligent people? I mean, they built businesses, they understand math. Why would a wealthy investor suddenly sabotage their own perfect plan?
Because the human brain simply is not wired to process absolute losses at that scale without triggering a massive biological fight-or-flight response.
It's just biology.
Yeah. The math of a percentage drop feels entirely different when the raw numbers get huge. A 20% drop on a $100,000 retirement account is a $20,000 loss.
Which hurts, but a rational person can endure it.
Exactly. But a 20% drop on a $5 million portfolio is $1 million vanishing into thin air on your computer screen.
That's terrifying.
The percentage is exactly the same, but the psychological terror it induces is completely different.
The Davies wealth management material highlights a scenario they call the $1.5 million mistake. Walk us through how a rational person does that.
Sure. Imagine a family with $5 million. A global crisis hits, and the market drops 35%. They log into their account and see that $1.75 million has evaporated.
Just gone.
Gone. Without a comprehensive, coordinated risk plan, pure panic sets in. They decide they have to stop the bleeding, so they sell $1 million worth of stock right near the bottom of the market.
But isn't stopping the bleeding sometimes the logical move?
Yeah.
I mean, how do they know the market isn't going to drop another 20%?
Because they aren't looking at historical recovery data, they are reacting to the immediate pain. And the mechanics of what happens next are devastating.
What happens?
First, they locked in the market loss permanently. Second, because they sold highly appreciated stock, they immediately trigger a $200,000 capital gains tax bill.
Oh, brutal.
And third, because they are now sitting in cash, terrified to get back in, they completely miss the inevitable compounding market recovery.
Do you add all that up?
When you combine the locked-in loss, the unnecessary tax hit, and the missed growth, that single emotional decision costs them over $1.5 million over the following decade.
It reminds me of altitude sickness. When mountaineers climb into the death zone on Mount Everest, the lack of oxygen literally makes their brains swell.
Right, they can't think straight.
Highly trained, intelligent climbers start making irrational, fatal decisions like taking off their gloves in sub-zero temperatures because the environment is simply too extreme for human biology.
That's a powerful comparison.
When the numbers in your portfolio get that high, your brain experiences financial altitude sickness. You need an external system, a guide with oxygen, to stop you from doing something fatal.
Which perfectly defines the ultimate shield in high net worth risk management.
The advisor.
Specifically, the role of the fee-only fiduciary advisor. When a family reaches this level of wealth, fragmentation is the enemy.
What do you mean by fragmentation?
Well, if your CPA is doing your taxes, your estate attorney wrote your will 5 years ago, and a broker is managing your investments, but none of them are actively coordinating, massive cracks form in the foundation.
Oh, I see. The CPA has no idea the attorney set up a cessiolat.
Right.
And the investment broker doesn't know the CPA is desperately trying to manage the income to avoid a Medicare IRMAA surcharge. It is pure chaos.
Exactly. A firm like Davies Wealth Management operates as the central coordinator. They act as the architect, looking at the entire blueprint.
But the crucial distinction here is the fee-only fiduciary structure, right?
Absolutely. A fiduciary is legally bound to act in your best financial interest at all times. They do not sell commission-based products.
Why does the commission aspect matter so much for risk management?
Because hidden commissions introduce hidden risks. If an advisor gets a massive payout for selling you a complex structured note or a variable annuity with high internal fees, they have an inherent conflict of interest.
They're financially incentivized to sell you something you might not need.
Right. Are they recommending this product because it actually fortifies your wealth or because it buys them a new boat?
Wow.
By stripping away the commissions and proprietary products, you remove the hidden risks and guarantee objective advice.
And more importantly, when the market does plummet 35% and that financial altitude sickness kicks in, you have a legally obligated objective professional standing between you and the sell button.
They act as a buffer.
They can calmly walk you through the math. They can show you exactly how the 3 years of cash reserves are functioning, how the direct indexing is capturing tax benefits from the crash, and how your trust structures remain completely intact.
They become the circuit breaker for panic.
It's the difference between blindly hoping for the best and systematically engineering a defense against the worst.
It's a complete paradigm shift.
It really is. We are moving from a world where risk management means filling out a 5-question survey and getting dumped into a generic 60/40 target date fund to building a bespoke, multi-layered fortress.
You're untangling concentrated stock with exchange funds.
You're neutralizing sequence of returns risk with calculated cash buffers.
Racing against the 2026 estate tax sunset by deploying slats and eyelets.
And you have a fiduciary quarterbacking the entire operation to keep human psychology from burning it all down.
That sums it up perfectly.
Which leaves us with a final thought to mull over. I want you to think about your own financial infrastructure right now, specifically looking for your blind spots.
It's a vital exercise.
If a sudden, completely non-market related event happened tomorrow, say a massive liability lawsuit involving your business, or a sudden, drastic change to the tax code, how much of your net worth is actually standing behind a sturdy, strategically coordinated shield?
A real shield.
And how much of it is just hiding behind a paper one? Are you navigating your financial future with a sophisticated GPS, or are you still relying on that plastic toy compass? Thank you so much for joining us on this deep dive. We'll see you next time.